This video explains important new terms that are proposed to apply to both revenue from grants and donations, and expenses on grants and donations. It also provides an overview of the recognition and measurement model that they will both use. Revenue and expenses from grants and donations is important for many nonprofit organizations, or NPOs, and users of their general purpose financial reports. This video aims to make the proposals in INPAG accessible to a broad range of stakeholders to stimulate valuable feedback. NPOs may receive grants, provide grants, or both. Grant-receiving NPOs have revenue from grants and donations. Grant-providing NPOs have expenses on grants and donations. The term grant expenses refers to the grants and donations provided by NPOs to other entities and individuals. It is not used to describe the expenses that relate to a grant an NPO has received, such as grant-funded salary costs. The IFRS for SMEs accounting standard provides only limited guidance on accounting for revenue from grants and donations. And it does not contain any specific guidance on accounting for grant expenses. A new section has been created in INPAG to cover all revenue from grants and donations, beyond the limitation to government grants in the IFRS for SMEs. The guidance is included in an expanded Section 23, with a new Part 1 titled Revenue from Grants and Donations. This guidance uses the concepts in public sector accounting standards and is based on IPSAS 47, Revenue. The IFRS for SME Section 24 on government grants has been repurposed, and INPAG Section 24 Part 1 covers expenses on grants and donations. This also uses concepts from public sector accounting standards and is based on IPSAS 48, Transfer Expenses. This approach was chosen because it provides a common recognition and measurement model for both revenue and expenses. The term grant is used in INPAG to cover a range of revenue sources. It includes grants as well as donations, which may or may not be for a specific purpose. Revenue from a grant is where an NPO receives resources, such as cash, services, goods, or other assets from an individual or another entity, without providing them with cash, a service, good, or other asset, directly in return. The resources received are used by the NPO for the programs and activities it carries out to further its mission or purpose. If the NPO provides a service, good, or other asset in exchange for the resources it receives, it is not a grant. In these circumstances, the NPO has a customer and will apply Part 2 of Section 23, Revenue, which provides guidance on revenue from contracts with customers. As with revenue, the term grant expenses is used to cover a range of expenditure, including grants and donations, which may or may not be for a specific purpose. A grant expense is where an NPO provides resources to an individual or entity by transferring cash or a service, good, or other asset to that grant recipient, without directly receiving any cash, service, good, or other asset in return. NPOs that provide resources are called grant-providing NPOs. While these NPOs do not get something back directly in return for the resources they provide, others will benefit. For example, the resources could be used for the provision of clean water through the construction and maintenance of a well. This would directly benefit those in the vicinity of the well, but will not directly benefit the NPO that provided the resources. Grants are different to the procurement or purchase of goods and services. Procurement arrangements involve the provision of resources, such as cash, services, goods, or other asset, to another entity or individual, in exchange for a service, good, or other asset. In other words, the NPO gets something back directly in exchange for the resources it has provided. For example, being provided with electricity in exchange for payment to a utility company. Grant arrangements that provide revenue for an NPO, or create an expense for a grant-providing NPO, are classified as one of two types. They are either an enforceable grant arrangement, an EGA, or another funding arrangement, an OFA. These terms have been adapted from IPSAS 47, Revenue, and IPSAS 48, Transfer Expenses. These standards use the terms binding arrangement and non-binding arrangement. The adaptations have been made because, in INPAG, EGA and OFA only relate to grants, whereas in IPSAS, binding and non-binding arrangements can also include contracts. Strict criteria need to be met for a grant to be an EGA. An EGA requires that both parties to the arrangement have both rights and obligations. In other words, the grant provider must have both rights and obligations, and the grant recipient must also have both rights and obligations. The arrangement also has to be enforceable by both parties, through legal or equivalent means. And finally, the grant arrangement must have at least one enforceable grant obligation, or EGO. A general statement of intent by a grant provider, that it may transfer cash or provide goods, services, or other assets, is not usually an enforceable grant arrangement. It may, however, give rise to a constructive obligation. In order for a grant to be an EGA, it must include at least one enforceable grant obligation, or EGO. An EGO describes the activity or action that the NPO must carry out to be entitled to the grant. An activity or action needs to be distinct and separate from anything else that an NPO is doing, so that both parties can assess whether the activity or action has been completed. In INPAG, an EGO is defined as a grant recipient's undertaking, in an enforceable grant arrangement, to achieve a specified outcome or carry out a specified activity, use distinct resources internally, such as services, goods, cash, or other assets, for a specified purpose, or transfer distinct resources, such as services, goods, cash, or other assets, to a service recipient. Because an NPO has to do something distinct and separate to be entitled to the grant, each EGO creates a present obligation for the grant recipient. It also creates a grant fulfillment right for the grant provider. This has implications for when grant revenue or a grant expense is recognized. Enforceability is a fundamental concept. On one hand, it means that the grant provider is able to require the grant recipient to complete the agreed activity or action. In other words, the grant recipient must satisfy its obligations to be entitled to the grant. On the other hand, the grant recipient is able to require the grant provider to transfer the amount agreed. If either party fails to meet its obligations, they can be subject to remedies for not doing so. Enforceability happens through legal or equivalent means. Legally enforceable rights will usually be sufficient to establish that there is an EGA. An EGA will exist even if in practice the legal rights are never or rarely used. Alternative processes may have the same effect as legal enforceability. This will depend on the parties involved and the jurisdictions in which they are based, and might be as a result of regulatory or customary practices. For example, regulatory oversight or regulatory powers may provide the parties to a grant arrangement with the effective means to enforce the arrangement. This could be through appeal to a regulator, where the regulator has enforcement power. This could apply even if the specific agreement is not legally enforceable. Therefore, the substance of the arrangement needs to be considered, rather than the legal form. A grant provider may have the ability to reduce or withhold future funding if a grant recipient does not meet its obligations. However, this is not a valid enforcement mechanism on its own. This is because the grant provider will not have a present obligation to provide the future funding at that point. However, if the grant provider has another EGA with the same grant recipient, and the terms of this other arrangement specifically allow the grant provider to reduce future funding, if the other EGA is breached, then this could be a valid enforcement mechanism. Clarity about enforceable grant obligations and grant fulfillment rights in an EGA is also fundamental. Firstly, each EGO and grant fulfillment right needs to be identified. Once identified, their standalone values need to be determined. This is the amount that the grant recipient will be entitled to for meeting an EGO, and the amount that the grant providing NPO will owe when its grant fulfillment right is met. And finally, there needs to be clarity about when each of them has been met, by assessing progress. Rights and obligations relate to distinct outcomes or activities, or internal use or transfer of specific goods or services. It may not always be easy to determine distinct rights and obligations, especially when activities supported by grants are interrelated or interdependent. However, related rights and obligations can be aggregated until this produces a distinct grant fulfillment right and EGO. The process of aggregation may result in the EGA having only one grant fulfillment right and one EGO. For example, the building of a community facility might be a single EGO even though different activities are required for it to be built, such as project management, design, construction, and fitting out, etc. Grant providers and grant recipients will need to be able to measure or report progress. This will often include updates about activities and spending, and when each enforceable grant obligation has been satisfied. Such administrative tasks are generally not a separate individual enforceable grant obligation. The same is true of compliance requirements such as those relating to procurement processes, money laundering, or modern slavery. Having explored EGAs in some detail, we will now turn to other funding arrangements, or OFAs. An OFA can be any arrangement that results in a grant or donation being made by a grant-providing NPO, or received by an NPO, that is not an enforceable grant arrangement. An OFA may be a written grant agreement, an oral agreement, or implied by customary practices. It is also an OFA if resources are transferred to a grant recipient, without there being any agreed or implied arrangement in place. This could include resources received through an online campaign or a voluntary donation. Where there is some form of agreement, there may be constraints on the use of the resources provided. A constraint could relate to the overall purpose, a region where resources are applied, or refer to a time period in which resources must be used. For example, a grant provider may transfer resources to an NPO to support its work on disaster relief, with a constraint that funds must be used within 12 months. In the majority of cases, such constraints are not expected to be specific enough to create a present obligation for the grant recipient. We have explained the two types of grant arrangement, namely enforceable grant agreements or EGAs, and other funding arrangements or OFAs. We will now introduce a common model for recognition and measurement of both revenue and expenses. For an EGA, revenue will be recognized as an NPO meets each EGO. Revenue is measured at the standalone amount due for the EGO. A grant expense is recognized by the grant-providing NPO when a grant fulfillment right is met. The grant expense will be measured at the standalone amount due for each grant fulfillment right. Revenue from an OFA will usually be recognized at the same time as resources are transferred, measured at the fair value of the resources received. A grant expense is generally recognized when the grant-providing NPO transfers the resources to the grant recipient and no longer controls the resources in the transaction. The grant expense is measured at the carrying amount of the previously controlled resources. There are separate videos linked in the description to this video that explain in more detail the recognition and measurement of both revenue from grants and grant expenses. Starting with grant revenue, in an enforceable grant arrangement, if the grant receiving NPO's EGOs are met, before the transfer of resources, the NPO will recognize revenue and an asset. If resources are received from a grant provider, before the NPO meets its EGOs, the NPO will need to recognize a liability. Turning to grant expenses, if a grant-providing NPO transfers resources before its grant fulfillment right is met, it recognizes a prepayment asset. Conversely, if a grant fulfillment right has been met, because a grant recipient has met its EGO before any resources have been transferred, the grant-providing NPO will have a grant payment obligation, and will recognize a grant expense and a liability. In other funding arrangements, the grant recipient may only recognize a liability if it fails to meet a constraint, and not before. Its failure to meet the constraint creates a present obligation. The grant-providing NPO may also recognize an asset, if they have a right for resources to be returned, because a grant recipient has failed to satisfy a constraint. It is important for an NPO to determine whether it is acting as principal or an agent in any arrangement involving grants and donations. As a principal, an NPO will be acting on its own behalf in the arrangement, in order to achieve its own objectives. As an agent, it will be acting on behalf of, and taking instructions from, another entity instead. It will be helping that entity in achieving their objectives, rather than its own. Such agency situations might occur, for example, where an entity does not have a physical presence in a particular location and wishes to rely on another NPO's network or logistics. To determine whether an NPO is a principal or agent, the key factor is control of economic resources, and we use the same principles whether the NPO is receiving a grant or making one. Control of the economic resources can be determined by considering who has the ability to decide how the resources are deployed, who has risk of loss if anything happens to the resources being provided, and who gets the benefit from the resources that have been used. Whether an NPO is acting as a principal or an agent is important to the financial statements. Where it is a principal, transactions are recognized in the financial statements. Conversely, where it is an agent, the NPO does not recognize the transactions, but rather provides information about the agency relationship. Where an NPO is a principal, it recognizes the gross amount of revenue or the gross amount of expenses. Where the NPO is not a principal, it is an agent. In that case, it recognizes as revenue only the amount of any management or administration charge, fee, or commission to which it is entitled. Where a grant-providing NPO is acting as an agent, it recognizes only the costs incurred in the administration of the agency arrangement, and not grant expenses. Any assets related to the agency arrangement, such as funding provided to the grant-providing NPO by the other entity, do not form part of the grant-providing NPO's assets or income. This video has explained the common terms and the common recognition and measurement model for grants and expenses. INPAG has introduced new terms, created specifically for NPOs, to describe these transactions. All revenue from grants and expenses on grants are to be classified as an enforceable grant arrangement or another funding arrangement. The existence or otherwise of an enforceable grant arrangement is fundamental to the treatment of grants received or grants made by an NPO. Importantly, revenue and expenses share a common recognition and measurement model, which has been adapted from IPSAS. We have also outlined the significance of whether an NPO is operating as a principal or an agent in a grant arrangement. We look forward to hearing your feedback on the proposals in Exposure Draft 2. The invitation to comment includes specific questions on the proposals explained in this video. To respond, visit www.ifr4npo.org/haveyoursay. Download a template response document, and upload your completed response or comment letter. Responses must be in English. The deadline is March 15, 2024.